How would you respond to a 50% reduction in the market and into your portfolio? I think this is something that a lot of retirees fear, especially because it's a doomsday scenario, but it's not completely out of the question. Now, we have had some corrections that are pretty substantial in recent years, but when you go from working to retiring, the dynamics shift completely. They do shift financially, but even more so, I think they shift psychologically. I recently went down the rabbit hole a little bit and read through a forum, and some of the responses I thought in there were interesting. I want to share a couple of the perspectives today of what the forum shared and how that can apply to your retirement. If we've not yet met, my name is Danny Sinowitz. I'm a CFP professional from Hyperion Financial. What I liked about this thread is it actually talks through what retirees have gone through themselves. It's a chance for them to actually experience some of the losses that they've had or how they've reacted, or more importantly, how they would react. The cool part about this is that each person offered some level of a different perspective, and I want to share some of the big takeaways that I took. And hopefully, if you're approaching retirement, that I think you can apply to your own situation as well. The first one is the actual shift of mindset that it takes itself. There are two big changes that take place when it comes to retiring. Let's start with the first fundamental difference, which is no more paychecks from work. Let's say that you do decide to stop working altogether. If that does happen and the paychecks stop completely from full-time or part-time work, you're now at the point where you could be relying, at least in some form or fashion, on your savings. And basically, what will that create in terms of an income stream? Now, again, there's also Social Security for most folks, there's pensions for some folks. And in terms of the actual amount that they're able to draw on when it comes to their investment portfolios and what they have saved, that can usually make up some other portion of this as well. But I do think there's a fundamental difference here. When you are working, usually there are certain things that you can rely on. Again, depending on your situation, this may be applicable, but for most folks, they can rely on a normal, steady stream of income. They can also rely sometimes on at least a COLA level increase, or increase in terms of their income to some respect. There could be a bonus that you could be getting. Many different reasons to feel secure in your work because you know at least an income stream is coming in. At retirement, while it may seem obvious, I think it's worth stating that that stops. So instead, you're going from dollars that you were previously earning at work to dollars that you are now responsible to recreate in some form or fashion. And I think the psychological component of that is one of the more daunting ones that many retirees end up facing. When you talk about two of the components or the constraints, I think that take place, the first one is the actual psychological constraint. What happens if you experience a sizable loss in retirement? That does not bode well in terms of actually you being able to sleep at night, thinking where are the funds going to come from? How long am I going to live? And how long is this chaos going to last inside the market? The other piece is obviously the financial piece. How long can you go before you actually do run into dire financial straits? So, those two things I think can be one of the things that are most on the minds of retirees. And certainly in this thread, I think that's one of the common denominators that I noticed as well. Everybody has a different level of tolerance, and that question is something that you need to answer for your own sanity. What's your level of psychological tolerance? How much of a hit would the market need to take in order for you to say, okay, I'm done, I'm out, I quit? For some people, it can go down to zero. For others, it may be just a couple of bucks that they can lose. You need to be able to answer this question from both a financial standpoint, but also the psychological standpoint. Now, I'm sure many have wanted to do this. I've never personally been punched in the face. And I think the old expression goes, and I think it was Mike Tyson who said it too, everybody has a plan until you're punched in the face. And I think that's real. It's easy to talk about planning or how you can handle loss when markets are at all-time highs or they're doing well and everything seems to be just fine. But when the market does get punched in the face and perhaps your retirement plan gets punched in the face, how are you going to react? I think this is where the emotional side of financial planning is all the more important. Again, it's easy to answer a risk tolerance questionnaire when the market's up, when things are going just well and everything is fine. But when the market takes a 30 to 40 to 50% dip, and it does so in a very quick way, it can be a little bit different for some retirees out there, especially ones that are relying on their portfolio to provide an income stream. This is where I think two things can end up either taking place. Number one, you could find yourself over monitoring your plan and overlooking at your numbers. I think it's important to stay informed, but I think there's such thing as maybe being quote unquote too informed or over monitoring to the point where you find yourself psychologically freaking out. If that is the case, you want to be able to step back and see what you can do instead. Now, I'm not saying you shouldn't be concerned or you shouldn't be worried if the market is taking a hit. In many cases, it can be validated. But something else that I think you also want to make sure of is understand that this is a possibility in retirement. It's possible that you could experience a 50% correction, and it's certainly likely that you're going to have some level of a serious correction if you live a 25 to a 30-year retirement. Again, how long that correction lasts and how bad is going to depend on the specific timing of the way that things go. But you shouldn't necessarily be looking at this of what can I do if this happens? It's what are you going to do when it happens? And again, that's something that I think is mentioned in the thread, which is all the more important. What a lot of retirees have answered, though, specifically in this thread, are building buffers that can withstand some of this. And I think they come in the form of two different types. The first are income buffers, and these are ones that really should not be affected in any which way. The most common ones you'll notice are going to be pensions and Social Security. Those sources right there are going to be guaranteed by the actual payment source. So, in the Social Security example, it's guaranteed by the full faith and credit of the United States and the Social Security system. Now, the Social Security system and the trust fund you may be aware of is potentially talking about some problems down the road, but we've been here before. We were there in the 80s, and we actually shot a video on this not too long ago that you should check out if you have concerns about Social Security's viability to pay. But we've also seen that Social Security, while it may be able to pay out, there are also pensions which unfortunately have quote unquote gone under. Some of these pensions are from private companies. So I think it's important to understand the financial strength of the actual pension provider that you have, whether that be an insurance company, whether that be a government agency, or whether that be a private company which is managing their pension funds. In any one of these scenarios, you just want to make sure that you are going to be relying on an income stream with a financial source that is strong. But being that those two sources are the ones that can be providing guaranteed income, it can take some level of risk off of the table for you as the retiree. Now, pensions for many non government employees are becoming a thing of the past. There are still plenty of pensions that are out there for some folks, but it could be the case where pension income is not going to make up what it did for retirees of yesteryear. Instead, what you're going to be likely to rely on is if you're fortunate enough to have a pension that can help supplement Social Security and other savings that you may have. And that is what I think makes up the second type of buffer that you could be holding, which are assets which are safe. I've often heard these referred to as a war chest or some type of cash holdings or something that you can withstand in the event of a market correction. And it could often be measured in terms of years. How many years of expenses do you have in cash? One thing that I noticed among some of the answers in the forum is that many folks are holding assets in low risk or zero risk investments, such as money markets or CDs, savings accounts, such as short term bonds. Some things that are maybe, again, not going to be paying necessarily the highest interest rate, but you're not holding them necessarily for the highest interest rate. You're holding them for when the proverbial you know what hits the fan. And when it does, you can end up making sure that you're able to tap into something which is not losing money. Rather, it's either going to be level or hopefully gaining a little bit of interest. By pulling from these sources when the chips are down, you can make sure that you're not cutting into assets which are already bleeding. There's also a contingency which was mentioned in the forum talking about collecting Social Security and doing so if and when the market takes a significant dip. If you're living off of stocks, bonds, or other types of investments in retirement, but those begin to take a significant decline, you can instead look to turn on Social Security to replace your income because Social Security income is guaranteed, whereas the stocks and bonds are not. This can be something which can help provide more stability when your retirement plan is currently unstable. Another retiree even suggested that a 50% drop, while they would certainly feel it, would not affect their standard of living. And that could be you. If you can look at your account and say that you can withstand a 50% drop, but still keep the same standard of living, that might be a lot different for your reaction than it would be for somebody who, say, would experience a pretty significant standard of living drop. And that can come from folks who are living off of 3, 4, 5% of their portfolio each year and creating that and using that as either discretionary or essential expenses. By making sure that you understand your income sources and how much you're actually living off of from your retirement portfolio, that will have all the more impact on a 50% correction that you could be experiencing in retirement. But this could be something which could actually create an opportunity in retirement, believe it or not. And I think there are a couple examples which that could take place. One that we saw in terms of an answer would be that in March of 2020, when the COVID pandemic was first hitting and the stock market was absolutely getting crushed as a result, one participant was able to rebalance and buy stocks at a lower rate. If you do recall, the stock market quickly responded in 2020, and even after the February and March carnage, by the end of the year, the S&P was up positively. I think this is also something which wasn't necessarily mentioned in the forum, but it's also a chance that you could take advantage of tax planning opportunities when the market gets hit. You could consider things like Roth conversions, where you're purchasing Roth dollars at a lower rate than you would be if you performed a Roth conversion at a market high. You can also look at tax loss harvesting or selling off some of the gains that you may have with some losses and resetting basis and non qualified accounts. So instead of panicking when this happens in retirement, perhaps it's an opportunity for you to make lemonade out of lemons. One retiree highlighted what I think is actually a bigger problem than just necessarily a 50% drop, which would be the duration of the drop. For many retirees, they accurately point out one of the most difficult times to retire would have been in the early 2000s. For those of you that may remember, the tech wreck of the early 2000s, 2000, 2001, and 2002 had represented significant downturns in the S&P and in the market in general. And as a result, if you were looking to live off of those funds that you may have saved in retirement while experiencing these successive drops, it would have been very difficult to recover from this. 2008 was just a few years later, and that would have further depleted your portfolio to the point where it could have been depleted entirely. If you're living in retirement and experiencing several downturns in a row, that could be where most retirees find themselves in position that it might actually be worth the sweat that you're perspiring. But even then, it goes back to what we talked about earlier, where you could look to have non-correlated assets when the market is getting hammered that you can live off of instead. I don't think it's a good idea to sell low. That's a situation where you could find yourself quickly running out of money, or at the bare minimum, it's certainly living a lifestyle that maybe you weren't expecting to in retirement. By instead focusing on selling off assets which are not getting hammered at the time, that can give you a chance to have your market-based assets recover. So perhaps it's recognizing when you've actually quote unquote won the game. When have you saved enough money that you can take some chips off of the table and instead move those to a safer allocation that you can live off of in the down years? It may still be worth keeping some portion of your nest egg in stock-based assets, things that will outpace inflation, because depending on your life expectancy, if you have 20 to 30 years to go, inflation will be a very real thing. But this could be an opportunity for you to instead make sure that you can take some chips off the table and instead save those for the rainy days that will be coming in retirement. I took away 4 questions on both the financial side and also the psychological side that I think might be a good exercise for you to be able to answer this and do the best you can to answer it honestly. The first questions I think are focused on the financial side. Number 1, how much income coverage do you have from guaranteed sources? This would be Social Security or pension income, and could in theory be part-time or full-time income as well. But your health could also have something to do with that. The second question I think that's worth asking is, what is your reserve size? How much of a war chest have you saved up? How many years do you have in reserve that you could live off of when the market is taking a hit? The third question then is your spending flexibility. Are you somebody that has $5,000 a month of essential expenses? Or do you have $2,500 a month of essential expenses and $2,500 a month of discretionary expenses? Defining what is essential and discretionary is all the more important. And lastly, what's your time horizon? I think we can all admit we don't know exactly when our time will be called, but we can have a general idea of if you're in good health, if you expect to live another 20 to 30 years in retirement, or if maybe that's overshooting it. Then again, if you're in great health, maybe you need to plan for a 40-year retirement. Regardless of the actual time that you have, you want to make sure that your spending flexibility and your time horizon are taken into account. But I think there's also 4 psychological questions that you need to answer as well. The first one is, what did you do in 2008? What did you do during the tech wreck? What did you do in the 2020 COVID crash? How about just a couple of months ago in March when the tariff talk started to heat up? How did you react in any of these situations? The closer you are to retirement will also help dictate maybe where you could be now. In 2000, if you were in your early 20s or 30s, maybe not a big deal. You didn't even notice it. But in this past March, if you're in your 60s and you're starting to sweat a little bit, perhaps that'll tell you psychologically how you can handle this. It's important to make sure that you put yourself in the shoes of a retiree, not an earner who is going to continue to earn these dollars and will be in position that you can just withstand some of these corrections. The second one is how you're actually monitoring your accounts. Are you somebody who obsessively looks over this every single day? Do you find yourself getting upset over a couple percentage points of a loss? If that's the case, psychologically, you may want to put yourself in a position where you're sitting down if you see that you're down 10, 15, 20, or 30%. In any one of those scenarios, you're going to see large dollars wiped off of your net worth. That can have effect on some people, and rightfully so. But will that affect your behavior? How about your lifestyle? Would it drastically change if you experience a 30% drop in the market in your portfolio? If that happens, well, you should again make sure that you construct your lifestyle accordingly. You may only be able to go on vacation when the market's up, and you may not be able to when the market is down. Perhaps it comes down to actually building a plan which can withstand some of these drops and not drastically affecting your lifestyle. And lastly, I think you want to make sure that you're in a position where if markets do crash, better yet, when markets crash, you don't put yourself in a regret position where maybe you are too conservative or too aggressive. One of the biggest things retirees can do is to avoid regret. Bottom line, I think there are some great takeaways from this forum, and I encourage you to actually read through it yourself. If you're able to get through it and you have specific questions or some comments that come to mind, be sure to link those in the comment section here. Otherwise, I think it's important to make sure that you as a retiree come up with your number and you come up with a number that you feel good about. That number is obviously going to be unique to you, but one number that every retiree needs to have is 168 figured out. If you're curious about how that number applies to you in retirement, check out this video right here.